This week, the market reached a new high and we officially emerged from the 2018 correction. With the resumption of the long-term bullish trend, the focus of our video this week is on using relative strength to select winners. So it makes sense that we would feature an opening quote on the subject. Thomas Bulkowski is a noted expert in candlestick charting and technical analysis. His quote suggests that if we want to make money, we should buy relative strength and sell weakness. We'll explore this concept in detail and look at the practical application. Before we look at how to use relative strength to select winners, we'll look at a summary of this week's economic data and interpretation. This week, data was light, but political headlines and the Federal Reserve more than made up for it. The economic data continues to show incredible economic strength, but as we say week after week, it seems that the housing market continues to be a soft spot in the data. As we'll see, the continued strength of the economic data week after week has driven the markets to new highs. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, stocks rose on trade and M&A activity. Talk of Turkey disappeared just like concerns over Italy's sovereign debt in June. On Tuesday, the S&P index surpassed the January high intraday, only to fade into the close on news of plea agreements in the Cohen and Manafort cases. On Wednesday, the media celebrated and debated the headline that the current bull market is the longest in history. I say debated because issues about the arbitrary nature of a bull market starting after a 20% decline were widely discussed in the media this week and last week. We have discussed a more technical definition in many of our previous videos. On Thursday, stocks drifted lower as trade talks with China fell on deaf ears. On Friday, stocks soared on insights on Fed policy from Jackson Hole. For the week, we closed up 0.91%, and the month and year-to-date statistics are provided at lower right. To set the stage for our look at relative strength, we'll quickly review this slide on how these videos relate to our strategy and emphasize two key points. In the face of uncertainty, we want to use our evidence-based model to determine probable outcomes versus making emotional decisions with our money. Our strategy involves executing trades in two time frames, long-term and intermediate term. We monitor trend strength in our long-term time frame based on long-term technical measures, including technical patterns and economic data. Investments made on this time frame include core holdings in major indexes. These are multi-year holdings. The goal of monitoring the trend is to determine when the trend is ending for two purposes. First, to avoid the substantial drawdowns associated with buy and hold strategies, and second, to determine allocations in our intermediate holdings to growth versus defensive assets. The trend may be driven by technology, consumer discretionary, and industrials for a year, and then rotate to include other components, such as materials, energy, and services. This time frame also uses technicals, events, and economic data. These sector holdings rotate as the trend and business cycle progress. The balance of the allocations to growth and defensive sectors and assets is in accordance with the strength of the trend, which is also a measure of the financial cycle. The strength of the long-term trend is the majority of our focus in these videos. This week's topic of relative strength applies to our core holdings and our sector holdings. So what is relative strength? Relative strength is used to measure whether a sector is beating the S&P. Relative strength is derived by comparing the price performance of one asset to another. In our case, comparing an ETF to the S&P. Using moving averages of this performance ratio, we can quickly see if a sector is outperforming the S&P. We're not showing price on this chart to make the relationship easier to see. If the moving averages have a positive slope, wide spread, and price is largely above, the sector is outperforming and has a higher relative strength value. As long-term trend followers, we can use the visual inspection that we just showed to determine trend direction and monitor turns in the trend such as tops and bottoms. Now let's move to practical application of our strategy. We begin with the fundamental or macroeconomic environment. For regular viewers, this is a familiar chart, so we'll move through this quickly. Our purpose here is to show year-to-date performance of the sectors. To quickly refresh, This chart shows the financial cycle in blue and the business cycle in orange. Industries that perform the best as we move through the cycles are shown across the top, and the phases of the cycles are shown across the bottom of the chart. We use this chart to determine where we are in the cycle and what sectors we should review. Let's look at the year-to-date performance of the sectors from strongest to weakest. Each of the sectors will list the ETF ticker symbol first. We have technology, services, and consumer discretionary. All of these offer insulation from dollar strength and the global trade war by being largely domestically focused. Next, we have energy, utilities, and financials. The underperforming sectors are industrials, basic industries, and consumer staples. The evidence on this chart confirms the second highest level of business optimism in 45 years. The highest level was reached under Reagan in 1983. So looking at the center of the cluster of strongest sector performance, this is where we are in the cycle. In the NFIB survey of business optimism, businesses cite regulatory and tax relief as the source of surging business and economic conditions. Business is creating so many new jobs that unemployment claims are reaching low levels not seen since the 1960s. So back to selecting winning sectors based on where we are in the cycle. Allocations to current leaders with careful risk management would make sense in our approach. But what sectors will assume the leadership mantle next? Industrials and energy make the most sense, although industrials are still suffering from currency headwinds and tariffs. Financials remain a mixed bag, but there are bright spots in fintech advances being delivered by the money center banks. The most interest rate sensitive sectors include materials, which would become a play mid-cycle or if we get an infrastructure push from the administration. Utilities and staples become plays late in the cycle. This helps us narrow down our focus on what sectors align with the current phase of the business and financial cycle, but it still doesn't tell us how these sectors are performing relative to the S&P. If we want to beat the S&P, we need to look at relative strength. Now we shift to a technical review of relative strength in the sectors. We'll leave the sectors from the previous slide here so that we can walk through them. Now let's look sector by sector. Technology shows strong relative strength compared to the S&P. Remember, these charts show the ratio of price performance in each sector relative to the price performance of the S&P. The moving averages all have a strong positive slope. The fastest moving average is on top, the slowest moving average is on the bottom, and there's good spacing between them. What do the other charts show? Improving business conditions have led to more hiring and created more jobs. This has led to rising wages, which leads to an increase in consumer discretionary spending. Consumer discretionary began outperforming the S&P in 2018. It takes time for pro-business policies to improve business conditions, which in turn improve conditions for workers and consumers. Industrials had a nice run, but have faltered in the face of tariffs and dollar strength. You can see where the trend changed to indecisive and then rolled over at the right side of this chart. Resolution of global trade disputes will likely restore the bullish trend. Remember, our approach uses the evidence on the charts today, not what could, might, may, or may not happen. We would want to see a resumption of the bullish trend for industrials to be more attractive than other sectors with better price appreciation. Materials are also continuing a long downtrend from the left-hand side of the chart after a period of infrastructure hopes. By now you understand how we can quickly visually inspect the relative strength of the sectors, so we'll move through the next sectors quickly. Energy is showing signs of turning and would warrant additional measurements of trend confirmation. Staples continue underperforming. Financials are underperforming, but may be making a higher low. Still, with a limited amount of funds to invest, the question we must always ask ourselves is, can I get a better return in one of the other sectors? Services have resumed a bullish trend. Now you have a general sense of how to use relative strength to evaluate sectors, at least at a very high level. But trends change. Before investing, you have to model trend strength. Our model of trend strength reflects our sector investment time horizon and approach. Because every viewer's financial situation and objectives are unique, you should consult a qualified financial professional before undertaking any investment decision. Let's look at our model scores of trend strength in the various sectors. Under our approach, we capitalize on strengths in leaders and watch very carefully for tops. We very selectively look for confirmed turns in laggards using very tight risk management, but most of the laggards are continuing to the downside for a reason. There's one theme uniting the leaders: domestic focus, sheltered from dollar strength, tariffs, and emerging markets. Since capital flows are global, a resolution of tariff disputes would likely reshuffle this significantly, which is why a model-based approach to using relative strength is so important. This chart is from our July 20th video and shows a cup and handle pattern with a price target of 301 in the S&P 500 ETF. For weeks, the market has dealt with political concerns, trade concerns, fears of a failed breakout at new highs, and many other concerns that were thrown at the market. Let's take a look at how this pattern unfolded. This week, the NASDAQ, the Russell 2000, and the S&P all made new lifetime highs. Whenever the market makes a new high, it's telling you something. As you can see here, breaking over the January high wasn't easy. We failed here and here, finding support each time and breaking out convincingly here. As of the close of this week, we are over a third of the way to the target of 301 from the breakout of the cup and handle. To recognize repeating patterns in the market, it helps to research and study market history. This is our research on all S&P 500 corrections from 1936 to present, with the statistics for the 2018 correction shaded in blue at bottom. Looking at the columns from left to right, the first column shows the peak in the market. In the 2018 correction, this occurred on January 26th. The second column shows the trough in the market, or the market low. Next, we have the high and low price, the percentage loss from top to bottom, the length of the correction in calendar days, the slopes of the moving averages that you've seen in many previous videos. The values in this column include positive if the slopes of all of the MAs going into the correction were positive, negative if all of the slopes going into the correction were negative, or rollover if the moving averages were in the process of rolling over from positive to negative as the top was formed. Next is the shape of the correction. Most corrections are either V-shaped or W-shaped. Whether or not we observed a divergence preceding the correction in RSI, and the one-year return from the peak that preceded the correction. You can pause the video here if you wish. Looking at the longer-term weekly chart, the market consolidated gains and corrected from 2015 through 2016. We emerged from the correction and the market rose steadily through 2017 and into January 2018. The market needed to consolidate its gains and corrected for the past 7 months. As you can see, we've reached a new high breaking out of the consolidation. Other indicators confirm the move. RSI is trending up, and MACD is also bullish. And the market is telling us that we're moving out of the correction and resuming the long-term bullish trend. Next week, as always, there will be green days filled with bullish headlines, and there will be red days filled with bearish headlines. Our job is to keep an eye on the long-term trend, a firm hand on the tiller using our model, and maintain our heading towards satisfying investment outcomes.
The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.